Hello, everybody, and welcome to Commodity Culture, where we break down the commodity space for both new and experienced investors. Before we get started, standard disclaimer, nothing here is investing advice. Do your own due diligence. And today's guest is the portfolio manager and consultant of Feneck Consulting, which provides exclusive insights and commentary on investments in mining and energy. It's Mr. John Feneck. Welcome back to the show.
Thanks, Jesse.
So I want to get started with the broad market and how you see it positioned, because we've seen both the S&P and the NASDAQ perform quite well this year, and yet there are a ton of analysts out there telling us there's a recession on the horizon, greater pain to come. There's a number of alarming economic indicators people are pointing to. So what's your take here? Is this just a disconnect between the psychology of the market and the facts of the data?
It's a great question, and we have been one of those parties that has been incorrect, I guess you might say, about the fact that we thought there'd be a broader correction than we've seen thus far here in April year to date, especially given the news that we saw starting March 8th with Silvergate, right? I mean, that was significant in my opinion. A lot of your listeners may not have been investing in '08 like I was, but I remember Lehman like it was yesterday, and we had weeks in between the first and second, banks to go down or asset managers to go down, right? So like this was boom, 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 boom. I mean, and then nothing, right? So it's been really interesting to follow. There's going to be a lot of books written about this time period, I think. But to get to your question, we were on Kitco last June with David Lynn talking up the possibility of a recession by summer of this year. So we were one of the people putting our neck out there at that time. In the same day we did that, Janet Yellen was saying there's no possibility of a U.S. recession. Now, if you look at her commentary, she's getting more guarded. When you look at her comments about the $31.4 trillion debt, ceiling in the U.S., she's very alarmed. Lagarde, who is the ECB head, today came out in the press saying that the U.S. could never default. When you say never and guarantee and these kind of stupid words, in my opinion, you're setting yourself up for failure. So basically, we are taking the other side of that trade and selectively, going short certain things that we think are extended. And we're patient, right? I shorted retail last year. I got smoked on Spotify, for example. I shorted at $1,000 pre-split. It ran to 1,700. I was down 70% on my short position. I did not cover. I covered in the 600 range and made 40% on that trade, right? And that takes a lot of guts. But we basically have been shorting for 23 years. Not in our mining portfolio, by the way. We just started, we don't short the mining sector, but we basically can, as of 2020, because I saw the, volatility pick up and I said, wow, I have to kind of change my mandate a little bit, right? But to get to your question, I mean, the S&P is at 4150 right now. We've been saying 42 to 4300 is sort of, resistance. And if you look back at August of last year, I may be getting this incorrectly, but I think mid-August of last year, we saw 4305 on the S&P, and that was sort of the high. So 4300 seems to be still that kind of looming line in the sand that the S&P can't get through, just looking at that one index.
So do you expect further this year for a recession to actually happen? Because obviously that's the big question here. When will we see it? What will the impacts be? I've heard some people say that the pain to come and the repricing of asset valuations is going to create pain that will last a generation. People will be staying away from risk assets. So some people are calling for quite a dramatic fall. I've heard others who are completely on the other side who actually say, a soft landing is actually possible, that they're more in that camp. So where are you right now, given the data you've seen recently?
Yeah, I mean, the Fed has said over and over again, we're going to be data dependent. So I think as an investor, you have to follow that mantra, which most people don't, right? They go over their skis into things like Bitcoin, like financials, and then they wonder why they're losing all this money. It's like, you need to follow what the Fed is telling you. We have also been one of the only groups that I'm aware of outside of Jeff Christian and a few other mining groups that has been talking about the Fed being hawkish into 2023. And we were absolutely right. There were many of my contemporaries, Jesse, as you know, in September, October of last year that were calling for rate cuts by that time. We have not seen any rate cuts, right? So look at the Fed watch tool right now as an investor or a listener. It's showing you May 3 that there's an 85% probability of another 25 basis point hike. So this idea of, oh, the Fed's going to cut right away, oh, the Fed's going to pause. We already saw that verbiage going out of most investors' mouths March 8th, March 9th, March 10th, right? When you see Silvergate, Silicon Valley, Signature all go out, they're like, well, of course the Fed is going to cut rates March 22nd or a pause. And that didn't happen. They actually raised 25 bips. So, that leads us back to what we just said 5 minutes ago. You have to follow what's actually happening rather than what you'd like to happen. Of course, I'd like to see a rate cut. I'm positioned for a rate cut, but I think I have to be accountable to my clients and followers to say, this is what I'm actually seeing.
So I wanted to get your view on gold and silver now, because they've been performing quite well as of late, with gold almost touching all-time highs here. So from both a technical, because I know you use technical analysis a lot, and also a fundamental perspective, how do you see gold and silver positioned right now, and how do you think they'll perform? Will we see new all-time highs in gold in 2023 in your view?
Yes, we will. And from knowing me for about a year and a half now, for me to say that is a stretch, right? Because I've been very pragmatic about the price of gold. In fact, I was on your show last year and I was saying that we could, test that 1675 level to 1600, and we got to 1650 a couple of times, remember? And we springboarded off of that all the way to 2000 plus, which is a pretty awesome sight, right? And that's what you want to see are these what we call thrust moves in gold and GDX and GDXJ, right? Even silver for that matter. And yes, I am more of a technical person, and this is where there's a caveat or an asterisk in that March 8th changed everything for gold and silver. That is bringing in a lot of new investors, right? That said, oh, I didn't know my bank could go out of business. Oh, let me check my FDIC insurance at $250K. Like look at the outflows of the four major banks in the U.S. since March 8th. It's over $250 billion. And I'm probably lowballing that big time. But that's $250 billion out in a month. And that is telling you there's a crisis of confidence, in my opinion. If a big boy like Wells or someone has some struggles, look out below. It's going to be, you would have wished as an investor that you had some shorts protecting your long positions, or at least some hedges, right? Do some options. I don't know. We don't advocate options because they are complicated for clients. We try to keep things very simple. It's either we like it or we don't, right? We're going to buy it or we're going to short it. But to get back to your question, yeah, gold hit 2063, I believe, on an intraday. And we think it could get back to 1950-ish, maybe even 1900, because again, when you look at the chart, just this year, we retraced all the way to 1790 to 1800, right? And so when we last talked in the fall, or actually we talked in January, so the previous time we were at 1615 as a low, correct? Then it's like 1700, then it's 1790. What we call this is a series of higher lows, right? And that's a very bullish chart pattern. If you look at the gold chart going back, 5-10 years, it looks even better. So I think we're going to see all-time highs this year, absolutely. And that's why we're buying gold equities right now, because you want to buy these little names that many people don't follow, or analysts haven't had the guts to follow. And you have to put your neck out on the line here to say that, okay, this rally is real this time. And it is not just a technical thing, it's a fundamental thing. So, we just started to track it and purchase some Cerrado gold, which is CRDOF. Mark Brennan, I've known for about a year now. He runs another company called Ascendant Resources, which is ASDRF. I like Ascendant before I even tracked Cerrado, because Ascendant has got news flow coming here, as they just telegraphed yesterday. They've got an FS coming in May. So, when you're looking at here mid-April, you've got very little time to wait. And it's in Portugal, which, I challenge myself all the time, Jesse, to learn new things, right? Portugal was not on my radar before I met Mark last year as a jurisdiction, but in getting to know what the Portuguese government is about, they are behind this project, right? So that is huge. When you look at a junior, that's one of the first questions you should ask as an investor is, what are the roadblocks? Not what are the successes or the upside. It's like, what could go wrong here? And I don't see things going wrong with the government, at least, in Portugal. So that's a positive. But Cerrado, just had some really positive news yesterday, actually, about their full year production. And March 7th, I believe, they acquired Voyager Metals. So they're doing some interesting things at the company, and the chart looks like it's starting to move up. Another one that we just started to look at is First Mining Gold, which is FFMGF. As you know, Keith Neumeyer from AG, First Majestic, was involved in that company originally. Dan Wilton now runs the company. And if you look at their news over the last few weeks, they basically sold their non-core royalty portfolio for nearly $7 million Canadian. And they also had some news on Springpole. But they've got two large projects now, which I think investors miss. They still think it's like a one project kind of deal, and it's actually two large projects in good jurisdictions. So, here at 0.137 cents, I mean, the all-time 3+ year low is 12 cents. So again, like you're getting an opportunity to buy something at 12, 13, 14, wherever, and watch it go to 20 plus, right? If you look at the chart, there's a lot of upside in a stock like that because it is, they have some serious, potential there.
Great. Well, I'd like to shift attention now to natural gas because this is something we were also discussing in January at the VRIC. And you mentioned it was starting to get to a low enough level where you were getting interested in potentially buying the commodity itself. So I'm wondering if you have been investing in natural gas. And I think you mentioned the GAZ ETF is a way to get exposure. Do you think that's the best way to play things when it comes to natural gas?
So I can't say it's the best way. It's the way we're going to play it because UNG is the popular ETF of choice. But what most investors don't understand is that produces a K1, right? And I don't want to deal with a K1. If I'm going to do a K1, I'll do all sorts of MLPs and other things that generate K1s, because if you do one and they're late, then basically you have to file an tax extension, which is something I don't like to do.
Yes, that is a great point. I got into trouble with a K1 as well. I think it was a Plains All American. I invested in them and found out that I just had to sell it right away, and that's a major headache. I did not know that about UNG, so that's a great point. They also have a fairly expensive management expense ratio. I think it's like 1.1 or something like that. So that kind of turned me off a little bit as well.
Yeah, just while we're on the subject, I mean, MLPs, I have a background in MLPs. I actually worked for the largest MLP provider in the US out of Texas. So I know that sector very well. And that's part of the reason our energy portfolio has done so well over the last 4 years, is that I went pretty heavily into MLPs at the onset of our portfolio 4 years ago because I have that background. You could have bought Plains, you probably bought PAA, and you could have bought PAGP, which is the general partner version of that same stock, and that does not generate a K1. So there's a lot of little nuances that we teach clients like that to avoid headaches that can be costly, right? Some accountants charge $300 to $500 just to file a K1. So anyway, getting back to GAZ, it's trading at $11 right now. And I did put a very small, like 50 share, I like to do things sometimes just to just have stuff on my screen, right? So, I put $1,000 into GAZ in the 20s. And now it's at $11, right? So I'm down half on that position. And that's why you don't go all in my opinion, on your first buy, because I tracked that from $53 to the 20s and then bought it down over 50%. And I'm still down 50%, right? At 11. So things can fall a lot further than you think in mining and energy. And that's why we say, yes, you can go to Seeking Alpha or some website like CNBC and get free advice, but free advice is not good in a market like this where you really need to partner with someone that's a professional like myself, or whoever you want to reach out to. It's just doing nothing at this point in the cycle is not a strategy for us. And we tell clients it's just important for you to pay something to get that the guidance, that confidence that you need to build to get, invested, right? So like getting back to GAZ, we're going to buy more of it down here. I've got a couple bids out today in the 10s. I'm going to see if I can buy it near the 3-year low here in the 9.5 to 10 range. And we'll see what happens, because natural gas is a commodity. It's not a stock. It's not going out of business, right? It's just in a huge downturn.
Right. And speaking of natural gas, Trillion Energy is a company that we've been discussing every time you're on the show. And I've been looking deeper into that company myself. So I'm really curious on your thoughts at where it currently stands. For myself, all my oil and gas plays are currently in North America. So I was thinking it was also nice to get some geographic diversification there. So I'm wondering what your current view on Trillion is and the jurisdictions they're operating in, because we know that investors with North American jurisdictions can get kind of uncertain about things. So how do you see those jurisdictions and those governments playing out in terms of their relationship with Trillion?
Yeah, so it's a difficult one in that I don't have years and years of experience in dealing with like a Turkish government. I can just say that I did my due diligence when I put my first position on in Trillion, which was, gosh, I think about 3 years ago now, around 4.5 cents US. The ticker is TRLEF. Basically, I just saw a major discovery right adjacent to their property, right? And I said, someone is going to pay attention to this eventually, or they're just going to, do more, find more gas eventually down the road and go into production, right? And at the time they weren't producing, but now they are. And I think they're going up to 11 or 12 wells this year from 4 last year. So when you see that kind of production growth, Jesse, you want to buy it before the production numbers come out, right? Because now they're going to generate, a lot of free cash flow, in our opinion, over time. But yes, the jurisdiction is something that people need to look at. I would point out the last time I talked to management was probably last fall, and they really had a good relationship with the Turkish government for the previous 8 to 10 years. So that is their number one client, right? That's always a positive when you have the government buying your, whatever you're producing, because you've got a really nice anchor, if you will. So that's my thoughts. I think it's very inexpensive here at 27 cents US, but it will have, the need to raise more money as the year progresses, probably, or next year, because it's still a junior.
Yeah, great breakdown. So I was also wondering if there's any commodities you're currently watching or investing in that you think are maybe off people's radars, that people aren't paying so much attention to, but that maybe warrant a closer look.
Well, I think silver needs to be mentioned because, as you know, I've called for a test of 18 to 19 on your show last year. That actually happened. We got to 1760. But look at the bounce off of that 18-ish kind of level. That's why we do technical analysis, because now silver's at 25.10. And silver is our third largest position, right? So yes, I have every reason to tell your listeners, there's going to be a Fed rate cut tomorrow. Silver's going to 50, but none of this is true. So, basically we have to look at silver as we're going to hit 26.50-ish and have a little bit of resistance. You saw it hit 26 plus on April 13th, last Thursday, and pull right back, right? So 26.50 to 28 is sort of that zone for me. That's resistance level number one. And then 30 is obviously that big line in the sand that has to get broken. I think it has a shot in the next 6 to 12 months to get through 30 with some strength. And if you do close over 30 a couple of times, we would hope that your listeners have already bought silver juniors, because they're going to fly. A few of them to mention, Guanajuato Silver, GSVRF. I just met with them on Friday. They are, the epitome of a value silver stock. When you look at what they did with the Great Panther assets they bought last year, very inexpensively. And then previous to that, they bought Endeavor's El Cubo complex in Mexico. They've done a tremendous job of really buying assets on the cheap and then adding a geo in Ramon, who has years and years of experience in Mexico. So Ramon was the right-hand guy to Keith Neumeyer at AG for many, many years. And for a junior to have someone of that expertise on board, it's pretty exciting. The stock's at 41 or 42 cents today, US. It's run up from 25, but I still think there's a lot of upside as the year progresses and silver starts to break out. Another one to mention, SilverX had major news overnight. SilverX bought the Orcana mine complex in Colorado. Now, this is a Peruvian junior that is smartly diversifying outside of their wheelhouse, right? Like, Peru, I think you're out of the woods, but who knows, right? Like, I mean, Castillo was a mess for that country for quite a number of months, right? So if someone like that comes in to follow him, at least now they have asset number two or complex number two that they can say, okay, well, we're going to focus our efforts on drilling this for a while, right? So I think the key takeaway from today's press release is they're getting all of this for $4.5 million. I mean, unbelievable. When you look at what people were promoting for Arconda's value, there were a number of them out there at much higher valuations for that complex. This is probably one of the best values I've seen in many years, in silver, that is. Now, yes, there is a pause in someone like myself and anyone to say, okay, well, that didn't materialize as Arconda's management and others had talked about. However, it is a past producing mine, and the way they're looking at it, Jesse, is we want to see $30 silver before we aggressively, start drilling this. So they're not going to start drilling it tomorrow. This is just a way for them to diversify their portfolio, and I think smartly.
Yeah, I like to see diversification of assets in companies as well. It usually catches my eye when I see, more than one, especially if it's distributed worldwide in different jurisdictions, as you mentioned, because that helps evade potential political risks if something does go wrong, as you mentioned, like another Castillo coming into power. So I wanted to end on the question of company valuation, because I'm wondering how you evaluate companies in the junior mining sector from a financial standpoint. Particularly, I'm talking about exploration and development, because all the traditional metrics kind of go out the window when you have companies that are not currently making money. So you can't use the Ben Graham, the Warren Buffett methods of evaluating companies, the traditional value investing. So is it robust economic assessments that you look for when evaluating a company's financials, making sure they don't have too much debt? What are the metrics you examine in that case?
So the three major reports, and I'm not going to get into this too deeply because people can Google search what these things mean, but 43101 is sort of the first landmark for an exploration company, that kind of a report. And then you've got a PEA, preliminary economic assessment. That's your next step. We love the PEA stage because you get to learn a lot more about the good, the bad, the ugly of that particular project. And then you really learn a lot more at the FS stage, feasibility, right? When you get into the PFS or FS kind of stage, you're looking at, I didn't realize that this is going to cost this much more to build this thing. And we've seen that as something we have been talking about for, at least a good year and a half. I remember Argonaut kicked things off by surprising the markets about a year and a half ago. And then Integra ITRG followed with some news that was not expected. And I don't follow Argonaut. I've just started to buy Integra here. But Integra's chart I tracked for months before I bought because it was just in serious decline because their cost of building is higher than they expected, right? So the market doesn't punish you for a day or a week. They'll punish you for months, potentially. And so you have to track things, be patient. Most people are not patient. They don't know how to buy stuff intelligently. They're going to be, they'll see gold over 2,000 and just start putting market orders in, right? And that's not something that we advocate for clients or followers. We show them, hey, if we're going to buy something like, I'll give you an example that we used on your old show, Golden Minerals, right? This is a stock that's on the NYSE Light, okay? You can buy it pretty intelligently. It's got good liquidity. Today it's trading at 26 cents. If I were a buyer today and I really wanted to buy it, I'd buy it at 0.2601, right? Why? Because there are institutional buyers out there that can only buy on the full penny. So they're going to be at 26. I'm going to be 1/100th of a cent ahead of them, make sure I get filled. Now, if I want to be patient about it, I'll be out there at 0.235 or 0.2401, right ahead, of someone else, probably 5 to 10% lower than where the bid is currently, right? To see if some guy is going to sell into me with a market order. And believe me, it does happen, not only on that stock, but many juniors. You get these people like you saw November, December, just give up, right? And they're going to call their broker and they're going to say, just get me out, and that broker may not understand that stock whatsoever, and they're just going to put a sell order in. And if you're smart and you've put your time in and you bought that stock intelligently with a limit order away from the action, you're going to get a really good fill price. So, there's a lot of things that go into your question, Jesse, but, we really rely on, looking at the capital structure of a stock, looking at the jurisdictional risk, talking to management over and over again. I mean, just using Golden Minerals as an example, I've talked to Warren probably 40 times in the last 2 years. I'm in constant contact with these companies, which a lot of your listeners don't have the time to do, which is, I think, a valuable service in itself, right? It's like we're saying, hey, we just talked to management about their public news today, and here's our 2-sentence kind of take on what's happening.
Yeah, well, that's a great segue to wrap things up and to have you talk a little bit more about Feneck Consulting. So for those who aren't familiar, could you talk about the service and then also anywhere else you want to direct people online?
Sure. Yeah, thanks, Jesse. I started the newsletter in 2021, so 2021, so 2 years ago. And we correctly called around January, in our January issue last year, we correctly called that the Fed was getting hawkish Jan 5, and we said there's going to be a series of rate hikes. And look at what's happened. I mean, to kind of go back to your question of like the what ifs of the broad market, show me another time. Have anyone just email me, a time in history where you've seen 5% in hikes from March to March. I mean, oh my God, like we don't even know what this is going to do yet. I mean, the real estate market is hanging on, but is it going to continue to be thriving going forward after a 5% move in rates? I don't think so. So, I've personally sold my vacation homes, rental homes over the last 2 years because I'm looking at this and saying, I don't want to be holding the bag when, real estate markets decline, and it is going to happen. I couldn't tell you when, but it is going to happen within the next, I'd say 12 to 18 months. And I've been trying to show my friends who want to buy something, hey, look, just look at this. Look at what happened here with the Fed and globally with other, groups, and just say, let's just rent a place for a little bit, right? Sit back and watch what happens, because I think there's a lot of markets in the US that are extended right now. But yeah, I mean, we basically talk about everything, Jesse. We'll talk about hard assets like real estate. We'll talk about, all commodities. Natural gas was an issue last year. We talk about gold, silver, but also things like palladium, copper, like the industrial side, right? But we also have a real-time service for more sophisticated investors that have more money at risk, that may want some macro news in their inbox when it happens, right? And so that would be March 8th. When Silvergate happened, I think 29 minutes later, we were out there with a full analysis, and our analysis basically said, this is not the first bank that's going to fall. When you have something like this happen, it's significant. We said that the crypto sell-off would occur, which it did, and is now completely rebounded, which surprises me, but that's a fact. And basically, we were going to start shorting a financial ETF, and that's what we did. And we made money on that trade because then, as you know, Silicon Valley followed, and Signature followed, and Credit Suisse followed. And it's like, man, this is a lot of stuff to digest for the average investor. So we have those two services for people, and we hope that people will check out Feneck Consulting. We just posted our performance for the quarter. We beat GDXJ by 6.5% this quarter. So, we're very pleased with that, and we think we're going to have a great year.
Great. Well, I'll put a link in the description below so viewers can check that out. Thank you once again so much for joining us, John, and look forward to having you on again for another update.
Thanks a lot, Jesse. Have a good one.
Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.